We'll be discussing the mock test paper which was scheduled on 17th of March 2019, chapter 18 to 33. Now, multiple choice questions. Question number 1 was Air Arabia Limited has paid 50 lakhs during the year ended 31/3/19 to Airport Authority of India towards landing and parking charges. So it has been judicially decided in Japan Airlines case that tax is to be deducted at source under section 194C. So here tax is deductible at source at rate of 2% under section 194C. Then A Limited credited 28,000 towards fees for professional services and 27,000 towards fees for technical services to the account of RAM in books of accounts on 12/11/18. The total sum of 55,000 was paid to RAM on the same date. Now here, since fees for professional services are different and fees for technical services are different, and the amounts so credited do not exceed 30,000 rupees in each of the cases. Therefore, no tax will be deducted at source from such payment. Then Hari, a salaried individual pays rent of 55,000 rupees per month to Mr. Raghav from June 2018. Which of the following statement is correct? So in case if an individual being a salaried employee pays rent of exceeding rupees 50,000 per month or part of month, he is required to deduct tax at source at rate of 5% on the entire rent paid in financial year 18-19 from the rent payable for the March 2019. Now, A Limited, an Indian company, the wholly owned subsidiary in Sri Lanka, and extends corporate guarantee to the said non-resident subsidiary. Its wholly owned subsidiaries in Sri Lanka, and A Limited is an Indian company, and it provides guarantee to non-resident subsidiary, and the amount guaranteed is rupees 90 crores, and the assessing officer has to accept guarantee fees declared by A Limited. So, as per the safe harbor rules, the amount of guarantee fees must be at least 1% of the amount so guaranteed, that is 90 lakh rupees. Now, ABC Limited is an Indian company, has paid dividend distribution tax under section 115O in respect of dividend distributed by to its resident and NR shareholders. Mr. John, a shareholder of ABC Limited and a resident of country X, has to pay tax in country X on dividend received. So here ABC Limited has paid tax and there a separate person, Mr. John, has paid the tax. The same will be covered is a case of what? Economic double taxation. It will be a case of economic double taxation because taxation is in hands of different persons here. An application for advance ruling was made on 31/5/18 in relation to transactions proposed to be undertaken by Mr. Andrew, a resident of Germany. On 7/7/18, he decides to withdraw the said application. So within a period of say 30 days, the application can be withdrawn as per the law, but in exceptional circumstances, the authority has the power to allow the withdrawal of application. The application can be withdrawn on 7/7/18 with the permission of AAR if the circumstances of the case so justifies. Then in country A is an NJ, and then the rate of tax at which interest is receivable by infrastructure debt fund under section 1047 is taxable in hands of Mr. Ram, a resident of country A. That is, he is a resident of country A NJ, and rate at which tax is to be deducted at source on such income is the if in case if any interest is received from infrastructure debt fund, it is taxable at rate of 5%. And since he is in NJ, the rate of TDS will be 30%, increased by surcharge and HEC. In October 14, Mr. Raghav, an Indian citizen who is a non-resident, if he is a non-resident, he has bought 500 GDRs from Alpha Limited issued in accordance with the scheme of the government. Now he sold 300 GDRs outside India to Mr. Joe, a citizen and a resident of country outside India. So if a non-resident transfers to another non-resident GDRs outside India, capital gains taxation won't arise. However, it is transferred to resident but ordinarily resident, then taxation will arise. So no capital gains will arise on sale of 300 GDRs, but capital gains will arise on sale of 200 GDRs, and as per the provisions of section 115 EC, the same will be taxed at a rate of 10% without indexation benefit. So the answer will be C. No capital gains would arise on sale of 300 GDRs, but the capital gains, it will arise on, say, the sale of 200 GDRs, and the same will be taxed in India at a rate of 10% without indexation benefit. Now, ABC Limited has two units. Unit 1 is engaged in power generation and Unit 2 is engaged in manufacture of wires. And both our units are set up in Karnataka. And since 20 lakh meters of wires are transferred from Unit 2 to Unit 1 at 125 per meter, where the market price is rupees, say, 180 per meter. So basically, if in case of inter-unit transfers, the transfer pricing provisions, say, would be attracted in this case. Now, which is not an eligible international transaction for the purpose of safe harbor rules. The preparation of user document will be coming under the ambit of eligible international transaction. Receipt of intra-group loans with amount of loan is denominated in Indian rupees. So it is not receipt, it is provision of the intra-group loan. So that won't be covered under safe harbor. Providing implicit export corporate guarantee. It is explicit corporate guarantees are covered. Implicit corporate guarantees are not covered. Then manufacture and export of core autonomous components will be covered. It's purchase and export, so it won't be covered. And receipt of intra-group services from a group member. It is low value added intra-group services, basically. So these number 2, 3, 4, and 5, they are not covered under safe harbor. So answer will be D. Now, XYZ Limited has failed to report an international transaction, which is a specified foreign company in relation to XYZ Limited. What would be the penalty? One is what? 2% of the value of the international transaction. Besides this, 200% of the tax which has been payable on the reported income. So this penalty will be levied. Then the answer will be 1 and 3. Now, Alpha Limited's total income for AY 1920 has been increased by 34 lakhs due to application of arm's length price provisions by the AO on transactions of purchase of goods from its associated enterprise. And the same has been accepted by Alpha Limited. So basically, in case of such increased income, deductions under Chapter 6A cannot be claimed in respect of such enhanced income. The answer will be B. And the provisions of limitation of interest deduction in respect of debt which has been issued by a non-resident associated enterprise would not apply when the expenditure by way of interest it does not exceed rupees, say, 1 crore. So answer will be this. Then ABC Limited took a sublease of a building from Messrs. Janvi on 1718 on rent of 20,000 per month. So here the rent is 20,000 per month. Then it also took on hire machinery of Janvi with effect from 15,000 per month. ABC Limited entered into separate agreements, but both the rents will be included here. And which of the following statements is correct with reference to ABC's limited liability to deduct tax at source? Assuming that 1 month's rent was received as a security deposit, which is refundable at the end of the lease period. So fundamentally, on security deposits which are refundable at the end of the lease period, tax is not deducted at source. So basically, tax has to be deducted at source at rate of 10% of the rental income and respect of 2% on machinery, rent of machine. Security deposit refundable at the end of the lease period is not covered under the ambit of rent. Now here Mudra Edco is an advertising company has retained rupees 15 lakh towards charges for procuring and canvassing of advertisement from payment of 1 crore due to Cloud, a television channel, and remitted the balance of 85 lakhs. So a circular has been issued Here, the relationship is not of principal and agent's relationship. Advertising agent company is acting in independent capacity. The relationship is on principal to principal basis. Therefore, there will be no liability of TDS in respect of rupees 15 lakhs which has been retained by advertising company. Now, Mr. X has acquired a house property at Mumbai from Mr. Y, a resident, for a consideration of rupees 90 lakhs on 26/18. On the same day, X has made two separate transactions acquiring an urban plot of land from Mr. C for 49 lakh 50,000 and a rural agricultural land. So here tax will be deducted at source at rate of 1% on rupees 90 lakhs. Regarding urban land, since the consideration is less than rupees 50 lakhs, there will be no liability of tax deduction at source, and rural agricultural land is also not liable for tax deduction at source. So TDS will be at rate of 1% of 90 lakhs. No TDS on payment of 49 lakh 50,000 and rupees 60 lakhs. A notified infrastructure debt fund eligible for exemption under section 1047 of the Income Tax Act pays 5 lakh to company incorporated in for foreign country. The company has incurred an expenditure of 12,000 for earning interest. The fund also pays 3 lakhs to Mr. Frank, who is a resident of a notified jurisdictional area NJA. So in case of NJA, the rate of TDS is 30%, and in other case, the rate of TDS will be what 5%. So tax will be deducted at source at rate of 5% increase by HEC on interest payment of 5 lakhs to foreign company. TDS is at rate of 31.2% is attracted on interest payment of rupees 3 lakh to Mr. Frank. Now A has failed to comply with the provisions of section 203A, for which penalty of 10,000 has been levied under section 272BB. Now he has approached to file appeal. So in such a case, the appeal fees will be towards commissioner appeals will be rupees 250 in respect of penalty orders. Now Mr. Ram, a resident individual, 55 years, has not furnished the return and his assessment has been made under section 144 at rupees 12 lakhs. In such a case, he will be liable to penalty under 270A at rate of 50% of the tax payable on rupees 12 lakhs. That is penalty of rupees 89,700. A private bank has not filed its statement of financial transactions or reportable account in relation to a specified financial transactions for financial year 18-19. A notice was issued by the prescribed authority on 1st October 19, requiring the bank to furnish the statement up to 31st October 19. So the bank has furnished the statement on 15 November 19. So initially, from 1st 31st of May, you have to furnish the SFT, and since you haven't furnished, you will be liable to penalty of rupees 100, 500 every day, during which, say, the failure continues till you receive a notice, and after the due date of notice, the penalty will be increased to rupees 1,000. So hence the amount of penalty will be 91,500 rupees. Well, 500 rupees every day for a period of say 153 days, and then it is 15 for 1,000 rupees per day for a period of say 15 days. Then Raman and Associates has made a payment of 2 lakh to contractors for carrying out job work at various sites, but has not deducted tax at source. Now, what are the tax consequences in such a case? First of all, you will be liable to penalty equal to the amount of tax not so deducted, as well as we will be 30% disallowance. So penalty equal to the amount of tax which has not been deducted is leviable in this case, and also 60,000 has been added back while computing the business income. Now, the assessment of Satpura Limited was completed under 143 with an addition of 18 lakhs to the returned income. Satpura has preferred an appeal before Commissioner Appeals, which is pending now. Now, which of the following statement is correct? Is basically incorrect. So, here, if a matter is being subject matter of appeal, then action cannot be taken under section 264. Either revision under 264 will be there, or say appeal under 246A is there. So, here this statement is incorrect that under section 264 the commissioner can revise the order pending the commissioner appeals if the revision pertains to matter other than the matters which has been covered before what commissioner appeals. All other answers are correct. Then Atlantis Airlines Incorporated in USA is operated its flights and has collected 280 crores for charges for passengers, out of which 100 crores were received in US dollars and 100 crores is been US dollars equivalent to 40 crores is say received in India, and expenses of operation the same won't be deductible. So basically 5% of the amount of carriage will be deemed income, and they are asking for the effective rate of tax. So effective rate of tax will be the tax will be increased by surcharge as well as HEC. Hence, the effective rate of tax works out to be 43.68%. That is 43.68% is the effective rate of tax in such a case. And Fly Limited, an Indian company, has to make secondary adjustments in AY 1920. If primary adjustment of transfer price is made by its CEO motor in its return in respect of, basically it will be in respect of assessment year 1819, and the amount of primary adjustment must exceed rupees 1 crore. So it is 1.05 crores would be the answer. Akhilesh is a non-resident Indian citizen, enthusiastic sports person, and is keen on contributing articles on a game of hockey in leading newspaper. He is a non-resident, but he is an Indian citizen. He must be a foreign citizen. Since he is an Indian citizen, then the taxation of such income will be at normal slab rates. If you would have a foreign citizen, then taxation will be at rate of 20%, increased by surcharge if applicable and HEC. Now, the assessment order under 143 in case of Mr. Z was passed on 31/3/19, and notice of demand was served on 2/4/19 for levy of tax and interest. Z paid the tax and interest on due on 12/4/19 and made an application under 270 AA on 27/4/19. And from immunity from penalty, he has applied under 270 AA, and the same was rejected on 14/5/19. So from the date when he has applied to the Commissioner for Immunity until the date the order of AO rejecting the application is received, that period will be excluded in time limit for filing of appeal, and the appeal is to be filed within a period of 30 days. So hence, from it will be counted from 2/4/19, that is 3/4/19 till 27/4/19. That's 27/4/19 to 14/5/19 will be excluded, and then the whatever that order was served on 15/5/19 to till this period, the same will be excluded, and then whatever is time left within a period of 30 days, appeal is to be filed. So the time limit comes out to be say 21/5/2019. Now, Mr. Sam, age 40, is a match referee. So for match referees, the provisions of concessional rate of tax of 20% is not applicable. That's provided under section 115 BBA. Here, TDS will be not as per the provisions of section 194E, but the same will be as per the provisions of the non-resident, that is under 195. Mr. Naveen is an employee working in the public sector. What will be the consequences? He has repaid a loan in cash 24,000 including interest. So interest will be included for determination if the loan amount including interest exceeds rupees 20,000, and in such a case he will be liable to a penalty under section 271E of 19,000 because the amount of loan is say 19,000 due to violation of the provisions of section 269T. Now, Samrat is a resident of Indian and earned a 4 lakh as lump sum consideration copyright of book from a publisher in country E. Here tax has been deducted at source. So here royalty income will be subject to deduction of rupees 3 lakh under 80 QQB, and the doubly tax income works out to be say 1 lakh rupees. In that particular circumstance, you have to say calculate the tax on the doubly tax income, and the same will be eligible for relief. The amount of relief will be the doubly tax income into Indian rate of tax. Doubly tax income into rate of tax paid in foreign country, say whichever is lower. So Indian rate of tax works out to be less, therefore the amount of relief will be 1950. And in order to claim relief under a tax treaty, one has to produce, a non-resident has to produce a TRC, tax residency certificate. So the answer will be in this case C. Question number second A, it was dealing with the transfer pricing issues. Now here, Amar Private Limited Bangalore is engaged in IT enabled services, and it is a subsidiary of ABC Inc. in US, and it also provides similar services to what SEC Limited at Singapore. Billings of A to per month to ABC Inc. is US dollar 85,000 and US dollar 70,000 is for SEC Limited. Now ABC Inc. has provided a loan of US dollar 1 lakh to Amar Private Limited at interest. Loan is at rate of 3% per annum. Direct and indirect costs incurred is US dollar 100 and 200 per hour respectively. And Amar Private Limited works 9 hours per day for 15 days to execute for the projects of ABC Inc. and 8 hours per day for 15 days to execute projects of SEC Limited. Service was provided to both the companies to its customers throughout the year, and warranty costs is for a period of 2 years, and the same has been provided to SEC Limited, and 1% of the direct costs incurred is the cost of warranty. And cost of warranty is not included in direct as well as indirect costs. So you are required to compute the arm's length price as per the cost plus method and the amount to be added, if any, to the income of Amar Limited. So first of all, we have to find out what is the margins which they are earning while dealing with the unrelated enterprises. That is, for Amar Private Limited, it basically works 9 hours per day for 15 days to execute for ABC Inc. and 8 hours per day for 15 days to execute for SEC. So the direct costs works out to be 12,000 rupees US dollars. Indirect cost works out to be 24,000 US dollars. So total direct and indirect costs while dealing with its unrelated enterprise is 36,000 US dollars. Besides this, the cost of warranty is also there. That is 120. Cost of warranty is 120. So here the total cost is what? 36,120 is the total cost. And the billings per month is 70,000. Therefore, margin after cost of warranty is 33,880. And as a percentage of the direct and indirect cost, it works out to be 93.8%. When the same is applied to what the direct and indirect costs which have been incurred with the associated enterprise, the direct cost there is 13,500, indirect cost is 27,000. Besides this, interest on loan is also to be worked out. That is interest at rate of on 1 lakh at rate of 3% per annum for a month works out to be 250. So the total cost works out to be 40750. And when the same is applied, that is the profit margins applied, it works the arm's length price works out to be 78,974 US dollars. Actual billing is 85,000 US dollars. Since the actual billing is more than what the arm's length price, hence no adjustments will be required in such a case. Then the next question number 2B was dealing with some of the issues relating to rollback provisions. So company X and company Y, they have entered into advanced pricing agreements and are eligible for rollback provisions merged to company XY. Now company XY is company XY eligible for rollback provisions? So company XY won't be eligible for rollback provisions here, since advanced pricing agreement will be valid only for those applicants who has what sought for such advanced pricing agreements. So since company X and company Y, they were APA applicants and not the new company XY, hence company XY won't be eligible for the rollback provisions. Then in case the question is issue number 2 was relating to there is a stay which has been obtained in respect of proceedings before TPO and the same was lifted, and after excluding the period of such stay, the only 30 days were available for the transfer pricing officer to make his order. So in case if less than 30 days is made, less than 60 days are available, then the period will be extended to 60 days. So here, the in present case, since only 30 days is available after excluding the period of stay, the same will be extended to 30 days and TPO can make the order within say 60 days. And the third one is the gross total income of Sachin and Company Pune was 70 lakhs, which is wholly attributable to unit in SEZ. And adjustments were made, and the income was enhanced by rupees 50 lakhs. So it is to be noted that if in case by application of transfer pricing provisions, if the income is enhanced, then no either Chapter 6A deduction or no exemption under Section 10AA will be admissible. So in case if the gross total income is after allowing the exemptions under Section 10AA, then in from enhanced income now income will be say rupees 120 lakhs. On that no Chapter 6A deduction shall be admissible. Or if alternatively if such income is treated before allowing the exemptions under Section 10AA, then on enhanced income of rupees 50 lakhs, no Chapter 6A or Section 10AA deduction will be admissible. Question number 3A was dealing with TDS provisions. Question number 3A, it was dealing with TDS provisions relating to what? Section 194H. Issue was key on the commission element. Tax was deducted at source. They were the air travel agents basically, and the tax was deducted at source on the commission. But airlines have offered them that they can sell the tickets at a higher price but not exceeding the maximum published price. So assessing officer was asking the assessee to deduct the tax at source between that is the difference between the minimum fixed commercial price and the maximum published price, treating it as an additional special commission. So here, basically, on the normal commission element, tax was deducted at source, and when they have made a purchases of those tickets, so whatever prices they realize, it will depend upon the agent when he's selling the tickets to independent parties. So if the maximum price is say rupees 25,000, say per voyage for a particular station, they can sell it at 25,000, they can sell it at 20,000 or 18,000, and the minimum price is say 16,000. So it is at the option of the agents. So hence it was held that the in Qatar Airways case that the difference between the maximum published price and the minimum fixed commercial price cannot be treated as what? Additional special commission in hands of agent, because the maximum published price is the maximum price at which the airline is granted permission the agent to sell the tickets at a price lower than the maximum published price also. For the airline company would have no information at which price the tickets have been sold by agents. There are thousands of agents and they cannot work out the same. Therefore, they must know the amount on which the tax is to be deducted at source. So having both the criteria into consideration, since it is not ascertainable in this case, since the agents were given a discretion to sell the tickets at any rate between the minimum fixed price and commercial price and the maximum published price, therefore it is impracticable and unreasonable to expect a airline to get a feedback from numerous agents in respect of the price at which the tickets were sold by them. Applying the rationale of the decision which has been given by the Bombay High Court in this case, there is no requirement of the tax reduction at source as contention of AO is not tenable. You have to deduct tax at source on the treating the amount as a special commission. It is not possible. Then question number 3B was dealing with the that is TDS provisions again. Here payment of 5 lakh was made by JCP and company to Pingu Events Limited for organizing a debate competition. So here basically the tax will be deducted at source under section 194C and not under 194J. Since 194J is applicable for specified not professionals, and those competitions, those events are sports events. So since debate competition is not an sport event, therefore 194J won't be applicable, 194C will be applicable and tax will be deducted at source on 5 lakh rupees at rate of say 2%. That is 10,000 rupees. The second issue was in relation to the profit commission paid by reinsurance company of rupees 1 lakh to the insurer company after expiry of the terms of insurance where there was no claim. So the profit commission paid by reinsurance company, it cannot be termed as what? A remuneration or reward for soliciting procuring insurance business under 194D. Hence, in this case, the amount of tax deducted at source will be say nil. Then question number 3C was in relation to calculation of the advance tax installments if Mr. X does not want to pay any interest. So he has earned business income, he has earned income from saving bank interest initially, and he has made investments in public provident fund. Then subsequently he is also receiving say dividends. So earlier the dividend is exempt in excess of 10 lakh, the same will be taxable. So when he will be calculating the gross total income initially, his total income works out to be 23 lakh 50,000 rupees, on which tax will be calculated. That is 5 lakh 38,200 rupees. So if you pay up to 12% of your estimated tax, you will be not liable to pay say the interest. So first initially the installment will be 12% of the tax due on the return income, though interest will be calculated if it is say less than 12%. In that particular circumstance interest will be calculated and the shortfall will be worked out from 15% of the tax due on return income, but up to 12% if you deposit, then you won't be liable to pay any interest. Then second installment will be say 36% of the tax due on the return income. Subsequently, in the third installment he has also received dividends, and that dividend has exceeded rupees 10 lakhs. In such a case he has received a dividend of say 1 lakh rupees, 8 lakh and 5 lakh in excess of 10 lakh rupees. So now that dividend will also be included. However, on dividend special rate of taxation is there, that is 10% under section 115 BBDA in excess of rupees 10 lakh. So that amount will also be considered. Beside this, he will be liable to pay tax on the normal income at slab rate, and whatever advance tax he has already deposited, the same will be reduced in the third installment as well as in the fourth installment. Beside this, then he subsequently after 15th March also is further earned a dividend of rupees 4 lakhs. So that additional amount of dividend will further be taxable, and whatever installments have been paid up to 15th of March, the same will be reduced to work out what the advance tax as on 31/3/19. So these will be the various installments of the advance tax. Then when can be the advance ruling be void? It can be advance ruling will be void if it has been obtained by say fraud and misrepresentation of the facts. And what will be the consequences? The copy of the ruling will be sent to the concerned authorities and will be treated as if no ruling has been say pronounced, and they can make the assessments as if no such ruling has been pronounced. Then authority for advance ruling has the power of compelling the production of books of accounts. Whether the statement is correct, yes, because they have the same powers as are vested in the court while trying a civil case. That is the code of civil procedure. They are the same powers as are vested in court, and compelling the production of books of accounts and other documents is their power. So the advance ruling authority has power of relating to what? Compelling of the production of such books of accounts. Then question number 4B was commissioner. They have first initiated action under section 263, and during the pendency of the proceedings on the basis of material under survey, after issue of first notice, the commissioner of income tax issued a second notice, the contents of the which were different. So can he do so? So here basically the commissioner when initiates proceedings under section 263, so whenever he initiates those proceedings, whatever documents are available at a time of initiation of such proceedings on record, on the basis of the same, he can issue a notice relating to revision proceedings under section 263. So after initiation of proceedings, if any further information comes, the same cannot be taken by him. So here, record shall include and shall deem to have included all the records relating to any proceeding under the act available at the time of examination by the commissioner. So, if any information, material, report, etc., which was not in existence at the time of the assessment was made and came into existence afterwards, the same can be taken into consideration for the purpose of invoking section 263(1). However, as per the explanation, such information, material, report can be relied upon only if the same forms the part of record when the action under section 263 has been taken by the commissioner. Issuance of notice under 260 succeeds what the examination of record by the commissioner. So in case since the commissioner has already issued a notice under 263 after examination of records which has been available by him, subsequent second notice on the basis of material which has been collected under 133A, which was totally unrelated to the irrelevant to the issues sought to be revised in the first notice. Therefore, the same cannot be regarded as record available at the time of examination by the commissioner, and hence such notice, second notice, won't be valid. Then question number 4C was relating to what provisions relating to 269 ST, that is in case if any person receives any amount in relation to transactions exceeding rupees 2 lakh in cash, then in that particular circumstance, the concerned person will be liable to a penalty under 271 DA. So here payments received otherwise than by account pay check, या account pay bank draft or use of ECS through a bank account is rupees 5,80,000 in relation to a transaction. Then even if cash payment is here, cash payment is covered, payment by bearer check is covered, though they may not be exceeding rupees 2 lakhs, but still they are covered if it is a payments are made in respect of a transaction. Now, since he has received 2 lakh in cash pertaining to invoice number particular 10/2018, he has to report the same in his statement of financial transaction. And for the payer, if he makes any payment exceeding rupees 10,000 in cash, that is otherwise than by way of account pay check or account pay bank draft or through use of ECS, then such expenditure shall be disallowed. These will be the tax consequences in relation to the transactions. Then question number 5A was dealing with double taxation reliefs. So countrywide relief will be admissible in respect of doubly taxed income. So here their income from house property has been earned in country B 4,40,000 and he has made municipal taxes of 10,000 rupees, that will be computed accordingly. Net annual value and that is standard deduction will be admissible and income from house property will be 3,01,000 rupees. Besides this, profits and gains of business and profession is there. In country B, there's a business loss of 1,65,000 and profits in business in India is 15 lakh rupees. So here it will be 13,35,000 rupees. Similarly, as written, agricultural income from country A, that is from outside India, the same will be taxable. Royalty income, the same will also be taxable, but will be eligible for specific deduction of rupees 3 lakhs, as well as dividend income from foreign company, the same will be taxable. So we will give you a deduction of rupees 3 lakh from royalty and the total income is 24 lakh 86,000, on which tax will be say calculated and the tax works out to be 23.3561%, and we have to give relief of on the doubly tax income. So doubly tax income of country A works out to be say 6 lakh rupees and doubly tax income of country B works out to be 3,86,000 rupees. So lower of the tax which has been paid in country A, the tax rate is 10%. So doubly tax income 6 lakh into 10%, and in country B the tax rate is what 25%. So Indian rate will be lower. So this way you have to work out the answers. Then question number 1B, it was dealing with whether the company is said to be engaged in active business outside India. So place of effective management, the concept is in relation to the same. The company is said to be engaged in active business outside India in case its passive income is not more than 50% of its total income. Passive income is interest income, royalty income, fees for technical services, or dividend income, or when the dealings are with associated enterprise. Both sale and purchase are from associated enterprise. And less than 50% of the total assets must be situated in India. Less than what? 50% of the total number of employees must be situated, say, or must be resident in India, and payroll expenses should be less than what? Less 50% of the total payroll expenses. So when we work out the all the aspects, first of is of passive income. Here the passive income is 43 crore rupees, and total income is, say, 100 crore rupees. Therefore, percentage of passive income is 43%. So, since passive income is 43% is less than 50% of total income, as the first conditions test is satisfied. And the condition number two is assets test. That is assets situated in India, that is fixed assets, intangible assets, and other assets is 160 crores out of total assets of 500 crores. So here the percentage of total assets which are situated in India in comparison, Indian assets in comparison total assets is just 32%. Since the value of the assets situated in India is less than 50% of the total assets, second test of is also satisfied. Then condition number three is employees test. So here the number of the employees in which have been employed in India is 30 employees have been there, and resident in respective countries 40 employees are there, and 60 employees are outside India. Therefore, only 40% of the employees basically is situated in India. Since the employees are less than 50% of the total employees, third condition is also satisfied. And regarding payroll expenditure has not been given, so it is presumed that payroll expenditure must also be less than what? 50% of the total payroll expenditure in India. So in this case, since all the conditions are satisfied, the company is engaged in active business outside India. Then the question number second was ki they want to increase their operations and want to employ 30 employees. So if they employ 30 employees in India, then their number of employees in India is out will be say 70, and the total employees will be 130. So their percentage increases to 53.85%. In such a case, the company will not be regarded as engaged in active business outside India because this condition won't be satisfied. However, if it can outsource the work and employ only 15 employees on roll, so their employees in India will be 155 out of total number of employees of 115. 55 are in India, so it is 47.83% only. So to be regarded as company is engaged in active business outside India, they must, instead of employing 30 employees on rolls, the company must outsource its work to whom? The outside agencies. Then question number 6A was dealing with the provisions of 94B, that is whatever excess interest is paid, that is in excess of 30% of earnings before depreciation, interest, tax, and amortization, the same is disallowed. Since if they are dealings with the associated enterprise, or say if the enterprise is an independent enterprise but the associated enterprise is guaranteed any given an explicit amount, or has, say, deposited a corresponding and matching amount of funds with a lender, then it will be treated as if the loans has been advanced from what? Associated enterprise. So in case if any interest has been paid to associated enterprise, the same shall not be deductible in computing income under the head PGBB to the extent it arises from excess interest. And what is excess interest? Interest which has been paid to the associated enterprise, or 30% of the amount of interest which is payable to them that is of earnings before interest, depreciation, tax, and amortization. So here business income is rupees 10 lakhs, and interest is to be added back, income tax is to be added back, and depreciation the same is to be added back. Earnings before interest, tax, depreciation, and amortization is 27.40. 30% of the same works out to be 8.22, and we have paid an interest to the extent of 9 crores, so excess interest is 0.78 crores, and the same will be disallowed and the same will be carried forward in the next year. Then next question was in relation to equalization levy, that is An Indian company is involved in manufacturing and trading in cotton garments, and they've expanded. They want to expand their export sales and have availed online advertising service from XYS Sky Inc. and has paid rupees 10 lakhs for the services in previous year 18-19. So here the Indian company, while making the payment, will be required to deduct equalization levy at rate of 6% since the consideration for such online advertising services exceeds rupees 1 lakh. And since the non-resident does not have a permanent establishment here, and in such a case, the amount which is paid as the on which equalization levy is deducted, the same will not be chargeable to tax in hands of such non-resident. The same will be exempt in hands of non-resident as per the provisions of section 1050. Hence, equalization levy is deducted. There will not be any requirement of deducting tax at source because the non-resident does not have any permanent establishment in India for deducting tax at source. Now here, the another question was in relation to 44 BBA. There is a non-resident was engaged in aircraft business. The 5% of the amount which has been paid or payable in India or outside India on account of carriage of goods, passengers, livestock, or meal or passengers shipped from any airport in India, or say amount received or deemed to be received in India on account of these goods, passengers, livestock, or say meals shipped from any airport outside India shall be deemed to be the profits and gains, 5% of the aggregate of the following amounts. So 2 crores is in India on account of carriage of passengers, the same will be included. Then 1 crore in India on account of goods, carriage of goods from Chennai, that also will be included. 3 crores in India on account of carriage of passengers from Singapore, that will be included. And 1 crore in Singapore on account of passengers from Chennai, that will be included. Hence, the total amount works out to be 7 crore rupees, and 5% of the same will be 0.35 crore rupees. That will be the profits and gains of business and profession, and the same will be taxable. No deduction will be allowed in respect of any expenditure. Now, here, the next question was in relation to GAR provisions. XYZ Limited incorporates SS INC in a no tax jurisdiction with equity of US dollar 500. SSINC has no reserves. It gives a loan of 500 to XYZ Limited at rate of 10% and utilize it for business purpose. XYZ Limited claims reduction of interest payable to SSINC from profits of business. There is no other activity. Can GAR provisions be invoked here? Basically, the main purpose of arrangement is to obtain interest reduction in hands of XYZ Limited and thereby tax benefit. There is no commercial substance of establishing SSINC since without there is no effect on the business risks of XYZ Limited or any change in cash flow apart from the tax benefits. Moreover, it is a case of round tripping of funds. Basically, the funds have been given to the subsidiary and then it is again say taken from that company. So consequently, in case of XYZ INC, interest payments would be disallowed by disregarding SSINC. No corresponding relief would be allowed in case of SSINC by way of refund of taxes withheld, if any. Then question number 7B was in relation to prosecution proceedings. Assessee has restrained and not allowed the authorized officer as per 132(1)(2)(b) of the Act to inspect the accounts and documents, etc. So their imprisonment will be up to 2 years and the concerned person will be liable for fine. Then assessee has deliberately failed to comply with the requirements of notices under 142(1) or 142(2)(a). In that particular circumstance, as per the provisions of section 276D, the concerned person may be liable for a rigorous imprisonment which will extend to 1 year and with fine. And if it fails to make the payment of tax collected at source, in such a case, prosecution proceedings can be launched which shall not be less than say 3 months but which may extend to 7 years with fine. Then 7C was key, the books of accounts. The person has not maintained his books of accounts. The assessing officer has levied a penalty for non-maintenance of books of accounts under 271A. Besides this, he has also levied a penalty under section 271B, that is for getting not getting the books of accounts audited. So it has been decided in Surajmal Parasaram Todi ki in case if the assessee has committed a failure and in consequence there is another failure, then he cannot be levied with both the penalties. So here, since a person has committed an offense by not maintaining books of accounts, penalty will be levied as per the provisions of section 271A. He will not be liable for penalty under 271B because that failure is in consequence of non-maintenance of accounts. Therefore, he has not get his accounts say audited. Therefore, the assessing officers is not justified in say levying penalty under 271B. For students who are pursuing say the new course, one was in relation to question was in relation to Article 13 of BEPS containing basic transfer pricing documentations. So, as we have already discussed under Section 285 also, there are what? There is one master file, there is one local file, and one is country by country reporting. So, the related provisions they have been discussed in Article 13 of the there is three-tier standardized approach for transfer pricing documentation. Master file contains basic information, is a high-level information relating to what the global businesses, operations, and transfer pricing policies which are to be followed by whom the multinational enterprises. And the master file is to be delivered by M&E directly to the local tax administrators. Then local file will be relating to specific transactions relating to what a transaction information relating to the particular country, that is in detail covering what the related party transactions, the amounts involved in those transactions, relevant financial information regarding the specific transactions, and comparability analysis and analysis of selection and application of most appropriate transfer pricing method is captured there. Local file is also to be delivered by the multinational enterprises to the directly to the local administrators. Beside this, country by country reporting is there. That is, the multinational enterprises are required to provide annual report of which of the economic indicators. That is, what is the amount of revenue, what is the profit before income tax, how much income tax has been paid, and accrued in relation to tax jurisdiction in which they do business. And CBC reports basically are required to be filed in the jurisdiction of tax residence of the ultimate parent entity, being equally subsequently shared by the other jurisdictions through automatic exchange information mechanism. And one question was in relation to how interest has been defined in Article 11 of the UN Model Convention and how fees for technical services have been defined. So basically, interest essentially means the income from debt, claims of every kind, whether or not they are secured by mortgage and whether they are not carrying any right to participate in debtors' profits. And particularly income from government securities, income from bonds or debentures, including premiums and prices attaching to such securities, bonds, or debentures. Penalty charges for late payment, they are not regarded as interest for the purpose of this article. And Article 12A of the UN Model Convention, it defines fees for technical services as payments for managerial, technical consultancy, but excludes what? Managerial, technical, or consultancy services, but excludes payments to an employee for teaching in an education institution or for teaching by an education institution, payments by an individual for services for personal use. Then one question was what are the other considerations while dealing with the tax treaties? So these are what ensuring non-discrimination between residents and non-residents, resolving disputes arising on account of different interpretation of tax treaties by treaty partner, and providing assistance in collection of fair and legitimate share of tax. Some of the other principles are what? Equity and fairness. That is, same income earned by different taxpayers must be taxed at same rate regardless of the source of income. Then neutrality and efficiency is there. Neutrality factor provides economic process should not be affected by the external factors such as taxation. Neutrality are either capital export neutrality or capital import neutrality. That is, capital export neutrality provides that business decisions must not be affected by tax factors between countries of residence and target countries. And capital import neutrality provides the level of tax imposed on non-residents as well as residents must be basically similar. And other aspect is to promote mutual economic relations, trade and investment. That is also to be observed in the tax treaties. That is, avoidance of double taxation must not be the only objective. The other objective may be to impetus to the growth of overall economic growth and development. So that is for promoting mutual economic relations, trade and investment. They can also be the considerations while entering into the tax treaties. So this was relating to the tax paper. There were mock test paper which was held on 17th of March 19.